Okay, hi everyone, welcome. Today I'm here with a very fascinating geopolitical analyst and strategist. He has a background in working for the World Economic Forum and doing geopolitical market research for IG before founding his own geopolitical research firm, Pantheon Insights. I'll put a link to it in the description there, his Substack, very worth reading. Dimitri Zabelin, great to have you here.
Thanks for having me. Looking forward to speaking with you.
Great. So we have a couple of things that I thought we'd talk about. We're going to talk a bit about oil and also about the elections we've been seeing throughout the world here with Mexico, India, and the European Parliament. But first, let's talk about last weekend's big event for the energy markets, the OPEC Plus meeting. The extended cuts were largely expected, but nonetheless, the future unwind of these 2.2 million barrels per day of voluntary cuts triggered a sell-off. And what's your take on this?
Yeah, so they increased production, but nothing too significant. It was up from roughly 400,000 to then 648,000, if memory serves. And it's divided somewhat equally amongst all the OPEC members. And really, Saudi Arabia is leading the cuts in all these measures and trying to elevate oil prices. And to understand that, you need to understand part of what's going on in Saudi Arabia domestically. So the Crown Prince, Mohammed bin Salman, has this Vision 2030 program. And people have heard about this. It's about moving Saudi Arabia away from primarily an oil generating nation to one that is more diversified in its modes of economic dynamism. So tourism, green energy. I actually just authored a piece recently for a Saudi think tank talking about the strategies that Saudi Arabia can take as both a geopolitically defensive and offensive strategy to become a leader in the renewable green energy space. A lot of these measures, though, and endeavors are very, very expensive and require a really high price per barrel, sufficiently high enough above Saudi Arabia's break-even rate to be able to fund all these major ventures. I think the reason why they were comfortable perhaps increasing production is that they believe that the current macroeconomic environment globally is conducive for absorbing that those extra barrels without necessarily it hampering down on the price. My view is a little bit different. I think that while we did see very impressive growth in H1 of this year, at least nominally, and this is something we can get into more, I think the second half of the year, we're going to see a lot more weakness because as far as oil prices go, largely over the long term, it's really a function of demand because we've seen in the past where OPEC cut production, like I think it was in 2018 and 2019, and yet oil prices continue to fall. That's because they were being injured by the trade war initiated by the US, not only against China, but against Europe and the multi-iterated effect that had across emerging markets that cumulatively weighed down on oil prices. I think in the second half of this year, when we are going to see, at least in my view, likely weaker consumer data out of the US as pandemic era savings dwindle, as we see anemic growth out of Europe, I think they're only scheduled to have between 0.8 and 1% growth annualized. In the US, our GDP was revised down. So annualized, we're looking at only, I think, it's either 1.6 or 1% growth, which means on a quarter-on-quarter basis, we went from growing 0.4% to 0.25. And I think as you begin to see that economic weakness, I think that's going to weigh on oil prices. And so I think in the second half of this year, I think that's where we're going to see a little bit more weakness in oil.
Yeah, okay. So if we look at the inventories, when do you think we'll see this in like inventory buildup or something like that?
Well, we are beginning to see a little bit of that in the US, if memory serves. And I think if we continue to see the lagging effects of tightened monetary policy in the form of layoffs, we see it in the form of weaker consumer data because oil is a very cyclically, sentimentally linked asset. So if you see weaker growth and you see weakened risk appetite, oil prices typically follow, barring supply-induced risks like the attack on Saudi Aramco or the drone strikes near tankers in the Strait of Hormuz or escalated regional tension that can temporarily push oil prices higher and exert a shadow price effect over the long term. I think despite all those things, I think we're going to see weaker growth in the second half of this year. And that's going to cause an inventory buildup in major oil producers like the US, for instance. And that will compound potentially the bearish forces that are dragging oil prices lower in the second half of the year.
And looking at the security situation in the Middle East here, with the stuff going on in Gaza, and also the risk of drawing Hezbollah and in turn Iran into a direct conflict. What do you think about that risk?
Well, we certainly saw a lot of escalation between Israel and Iran recently. But what's interesting is, even though we saw an unprecedented attack, which I know the word unprecedented has become a bit of a platitude, but in this case, it really is unprecedented, which is when Iran struck Israel directly rather than through proxies like the Houthis or Hezbollah. What's interesting is that even though oil prices ticked slightly higher as a result of that tension, they weren't surging, which indicates for me that investors also weren't taking these risks seriously, which means they knew, because if they legitimately thought a war between Israel and Iran was about to break out, oil prices would surge. They wouldn't have just blipped higher like they did. And that indicates to me that investors aren't really taking the geopolitical risks of the region vis-a-vis Iran and Israel that seriously as of yet. Of course, there is always a small risk that it could escalate into conflict. But at the current point in time, I don't think it's in Iran's or Israel's interest to engage in direct conflict because of what regional implications that could have. While it's not formally acknowledged that Israel has nukes or necessarily use them, although they likely would under certain circumstances, Iran likely wouldn't want to be provoked into a situation where Israel would be backed into a corner that they would have to necessarily use it. So while I do view these obviously as concerning geopolitical developments in the region, as far as their impact on oil prices, it seems quite limited, which indicates that markets aren't really taking those risks particularly seriously. And I don't think with the current circumstances that Benjamin Netanyahu is facing, particularly the pressure domestically and abroad, that he is exactly keen to start another war or a more direct escalated one with Lebanon while they're still dealing with the situation in Gaza and Palestine. Yeah.
But let's shift gears here a bit and get into politics. And it's been, just in the past week, there's been tons of stuff happening with major elections in Mexico, India, South Africa, and also the European Parliament here. And I know you did a piece on at least Mexico, covering at least Mexico and India. What are your thoughts here? What can we make of all this?
Yeah, so the market reactions, what's interesting is that there seems to have been a consistent theme throughout all these elections, which is fragmentation. Or not fragmentation, I'm sorry. That's not the consistent theme. With India and South Africa, there was fragmentation. So we saw how Modi's BJP party did not perform as well as expected. They did form an alliance. However, they failed to secure the majority that they needed. We did see domestic equities take a hit as a result of the concern that not having a supermajority or majority overall supermajority may hurt Modi's chances and ability to push forward certain domestic reforms, because the more parties obviously you have in any given government coalition, the more negotiations that have to take place, the more compromises that have to be made to account for the various constituencies of a coalition government. And we can see the effects of how precarious that could be. In Italy, with the Five Star League and Lega Nord, we saw how it was a far left and far right party that were anti-establishment that were precariously put together, but we saw how unstable that government was in pushing through some of its own reforms in its battle with Brussels. But going then back to South Africa, we saw how the ANC, obviously the big line going around is how it lost its majority for the first time in since 1994. And we are seeing now how they do have to likely make a coalition deal with the Democratic Alliance or the EFF. Democratic Alliance is more center-right. EFF is a little bit more left-leaning. Certainly when it comes to foreign policy, they are more friendly to China and Russia, which could have implications for some of South Africa's trade deals that it has with the US that's predicated on certain stipulations. And I can send the link to you, and you can put it later in the chat if you'd like, where I give a comprehensive breakdown about why, depending on what alliance South Africa makes, that could have foreign policy implications that could affect South Africa's trading relationship with the US. I think as far as Mexico goes, we saw really quite a sharp negative reaction to Scheinbaum's ascent. We saw the Mexican peso really sharply decline against the U.S. We saw domestic equities and like iShares, ETFs, products that have exposure to Mexican stocks, completely crater as well. Some down as much as like 7 or 10%, if memory serves. In my view, I think right now we're at this transition point where I think we're going to see a lot more volatility with the European elections going on right now. We are seeing how the Eurozone's three largest economies, Germany, France, and Italy, are all having their far-right parties perform much better than expected. I have some data on that I can maybe pull up in just a minute. So I think cumulatively, the reason why this has so much has such a big impact individually and as an aggregate is because when you have fragmentation and a break from standardized protocol, which you can sort of equate to government coalitions and supermajority governments, respectively, it's far easier to push through reforms. It's far easier to push through policy, and you're less likely to get watered down products. So I think that delay, particularly at a period of time where we have ultra high interest rates in historical terms, let's say over the last 30 years, especially between 2009, I would say, and 2022, we saw really low, easy interest rates. And when you see geopolitical risks emerge, because the macro fundamental circumstances may be more accommodative, those shocks can be absorbed. But if you're beginning to have weakening fundamentals, every geopolitical shock you get individually and then as an aggregate disproportionately has a greater impact because the macroeconomic environment isn't as fortified to be able to deal with these geopolitical shocks. I think it's interesting to look at that. This is not happening just in emerging market economies. Like geopolitical shocks and volatility is no longer confined to emerging markets. It's now a key feature of all states and economies, whether they are developed or developing. So I think that's like the bigger theme to be watching here.
See, yeah, this sounds super interesting. And about the European Parliament, do you have some general impressions that does this also play into the bigger theme here?
I mean, I think it certainly does. I think the success of some of these parties that we see emerging is a function of the failure of the center. The same way that I said in many ways the rise of Trump or the rise of Boris Johnson, and we saw Brexit in 2016, is really more so a function of the center left and center failing to address the grievances of some of their constituents. And this isn't me endorsing one party or the other. I don't really have those kinds of endorsements. I don't have any political personal views. It's more so, I think, and the broader scheme is this move towards nation first security taking precedence above everything else. And I'm not making a moral statement about whether or not that's good or bad, but generally, if you have nation first policies, that by definition is causes more fragmentation because it's focusing on each individual country's priorities. So as far as markets go, you could see a bit of balkanization. With the Eurozone, it's a little bit different. Obviously, it is a currency union, so there are different dynamics there at play. But as far as foreign policy goes, I have yet to see the impact it has on stocks. I think most people are concerned about what it could mean for the war in Ukraine and the idea of national European unity. I've yet to see what the results are and what the actual individual parties' policies are. No one has indicated, at least thus far, and I don't see why they would, leaving the Eurozone. Even when we've seen that in the past, last minute, they always change their tune. We saw that in Italy in 2018. We saw that with Greece in 2013, 2014, if memory serves. So it's difficult to see, okay, how much of these policies are people just espousing to rattle their base and how much of it is genuine policy. So we don't see what that is yet. So it's difficult to say what the impact on, let's say, the European, not the European currency, sorry, the euro or like the DAX or other domestic equity indices.
Right. I think, I suppose that one major driver in this development would be the changing role of China, how China has shifted somewhat in the last decade or so, and become very much more aggressive, both against the U.S. and their close neighbors and all that. would you agree that China is a major driver in this development and as an increased security threat for the stability globally?
I would say in some ways, certainly yes, because there's a reason why the US and Europe are looking to de-risk from China. And I put that in quotes because de-risking is decoupling with just different letters. It's the same principle, just without the connotations that we've come to associate with the word decoupling. I think what the greatest concern is, China is such a central node in so many supply chains for the West that de-risking or decoupling mean the same thing, meaning decentralizing supply chains is a form of offensive geopolitical tactics. It's a way to ensure that if China wants to squeeze the West the same way that Russia did with oil and gas in Ukraine and Europe, that they would be less exposed to those risks. I think part of the security concerns of the US and Europe are very much aligned in this way. As for the parties in France, Italy, and Germany, it's unclear. I know that Italy was the only G7 country to sign on to the Belt and Road Initiative, but if memory serves, I believe they're actually formally renouncing their partnership. When it comes to the rise of right-wing parties in Europe, I don't think there's necessarily, as far as I can tell, a unified approach on China and Russia. Some are more friendly to the idea of economic integration, but other ones like Italy's PM appear to be less so, because why else would they pull out of China's BRI deal with them? Which says a lot, because Italy has an unbelievably high debt, especially the debt to GDP. They have high youth unemployment, and demographically, they're facing a lot of challenges. So it shows that clearly there is a political priority as far as the Italian PM goes, to de-risk from China, to align with the broader Western goal of generally de-risking from Beijing as they get more aggressive. We did see how China did deploy wolf warrior diplomacy, but that ended up, pardon my phrasing, pissing a lot of people off, to be quite frank. And they found that maybe a more gentle tactic may be necessary.
Yeah. Okay. Yeah. Well, time flies here, so this is very much very interesting stuff that I would like to get deeper into, but we don't want to drag this out too long. So, but before you go, can you guess? Maybe if we both, you and I, could give two things that you or I think are not widely understood or appreciated when you look at the coming 6 or 12 months, maybe one for the bulls and one for the bears. Would that be okay?
Yeah, sure. So obviously everything I say here it's not financial advice. It's just my personal take. You do with that information what you will. Personally, I'm bearish on oil in the second half of this year for the aforementioned reasons. I think even with geopolitical shocks, I still think that ultimately oil will follow where the demand is. And the trends are indicating that demand is going to get weaker, because growth out of China is not as strong as expected, certainly not in Europe, and certainly not in the US. We're seeing it slow down. So I am more bearish on oil. As far as being bullish, so generally my trades are multi-year. I like to do thematic investing. I think over the next few months, I could see defense contracting stocks generating alpha. I think the current political environment internationally is very conducive for defense contracting stocks, particularly out of the US. Obviously, the entire global security architecture that we have is primarily a US-led order. That's why we have the US leading in securing global trade. That's why the dollar is the world's reserve currency. There's this mixture of trade, defense, and the dollar all mixing in together. Furthermore, what's interesting is if you look at how Congress has passed the National Defense Authorization Act, the NDAA, they've passed it consecutively for 63 years, so over half a century. Over that same period, though, we've seen how much Congress has become polarized over a lot of different issues, but yet it seems that defense is something they all agree on. For me, that indicates a secular stability and a secular consistency in defense contracting stocks catching a bid from, how do I put this, congressional agreement, bipartisanship. And I think with the current environment, we're seeing not only wars in Eastern Europe vis-a-vis Ukraine and Russia, but more so recently in the Middle East, escalating tension with China in the Indo-Pacific, increased joint military exercises with the Philippines, with Japan, with South Korea, a more belligerent North Korea. These are all tailwinds for defense contracting stocks. And generally, they've performed quite well and averaged out over 20 years. One calculation I found is that they generated an alpha of like 19% per year over the past 20 years, I think from 2000 to 2020, versus the S&P, which averaged about 9%. And I think it's actually technically 7% if you account for inflation. And I can send that article to you as well if you want to attach it to the video. So I could see how the current geopolitical climate is conducive for defense contracting stocks. We saw that how on October 7, without even knowing what was going to happen, the title of my weekly insight for that week was "Why Defense Contracting Stocks May Rise on Geopolitical Risks." And it was a rather morbid case, but it did prove to be true. After the October 7 attacks, Lockheed Martin, Northrop Grumman, Raytheon all rose between 7 and 10% the following day and remained elevated for the following weeks. So in summary, bearish oil, somewhat bullish defense. But again, not formal investment advice. And generally when it comes to my trading, I like to do more long-term thematic investing, which is perhaps something that we'll have to talk about the next time we do an interview like this.
Absolutely, we'll do that. Those are great takes, actually. I agree with a lot of that. And for my part, I would say that it's how the market underestimates the upwards inflation pressure from surging these commodity prices, and not just oil, but not so much oil maybe, but more like copper. And we've seen this inventory build up in China. That's why the housing market is not going at all well. So there's something weird about that. But this is going to raise input costs across the line, and historically we'll also have several occasions where we had double tops in inflation. It's usually not just one top and then back to normal. So I don't think this time it will be different. In the short-term perspective, I think we're likely to see the 10-year about 5% within a month or so. So other than that, I would say that we're long silver. I think silver is underanalyzed. I wrote a piece on it last weekend. We've seen limited or falling supply from the major producers like Mexico and Peru, and their combined production is down 25% since 2016. And at the same time, you have this structural increase from EVs and solar industries. So and the silver just closed above the recent peak the other week. So I think it's we find good reason to be bullish on silver here. Yeah. So I think if there's anything else you want to add to this for the viewers.
I don't think as of this moment. No, I guess your readers will have to wait until our next video to find out more. Yeah,
and I hope we can do that soon again, because I see there's so much ground to cover here, so much to talk about. And thank you very much, Dimitri. It's been great to talk. Hope to see you back soon. And don't forget to check out Dimitri's website and his Substack at Pantheon Insights. I'll put a link in the notes here, and so you can get this kind of intel straight to your inbox. And thank you very much, and take care.
Thank you. Take care.